Tonight, one company reports its earnings, and within seconds of that announcement, its stock could swing 13% in either direction. That's not a crash. That's just a normal earnings night for a stock like this. I'm Onyx.
And I'm Nova, and here's why that's exciting. We're going to use that one night on one real stock to teach you every major option strategy. What each one is, the bet it's making, and the exact math of how it wins or loses. Same stock, same night, all of them side by side.
And the fun part, the hook of this whole series, is that we won't know the answer when we start. So once the number actually comes out, you can come back and see which strategy actually won. Options class with a live final exam. First, a quick and honest word. Everything you're about to hear is really just the two of us thinking out loud, personal market commentary, made for learning and for fun. It isn't investment advice, and it isn't a recommendation.
And when we talk about a specific company, it's only ever to make a bigger idea click. Never a nudge to buy or to sell. So take it as a starting point for your own curiosity. Do your own research and make the call that's right for you. Before we touch a single strategy, the honest part. This is education and entertainment. It is not advice, and it's definitely not us telling you to do any of this. Options are genuinely high risk. You can lose 100% of what you put in, fast, and an earnings night is about as binary as it gets.
So think of the stock we're using, Micron, ticker MU, purely as a teaching dummy. A crash test car. We picked it because it has a big, clean, measurable earnings move which makes the mechanics easy to see. We're not rooting for it to go up or down, and nothing here is a position anyone holds. Deal?
Deal. Okay. Teach me options like I've never traded one.
Fair. 60-second version. An option is a contract that gives you the right, not the obligation, to buy or sell a stock at a set price before a set date. A call is the right to buy. A put is the right to sell. The set price is the strike. The date is expiration. And the price you pay for that right is the premium.
And one contract usually controls 100 shares, right? So the premiums sound small, but they're multiplied by 100.
Exactly. That 100 times multiplier is why options feel so powerful and so dangerous. A premium quoted as $57 is really $5,700 of exposure. Hold that thought. It's the whole reason this is high risk.
So why earnings night specifically? Why not just any random Tuesday?
Because earnings is a scheduled explosion. The whole market knows the exact moment a big, uncertain number is coming. That uncertainty does something dramatic to option prices. It pumps them up beforehand and deflates them after. And that single mechanic, which we'll get to, is the most important thing in this entire series. Earnings night just makes it impossible to ignore.
You said Micron's a memory chip company. Anything I should understand about it before we use it?
Just one thing, and it's a great general lesson. Memory chips are deeply cyclical, boom and bust, over and over. And cyclical companies play a famous trick on beginners. Right now a stock like this can show a high trailing price-to-earnings ratio and a low forward one. And a lot of people see that low forward number and go cheap.
And it's not cheap?
Not necessarily. And this is the rule to tattoo on your brain. On a cyclical, a low forward PE is often a warning, not a bargain. It usually means the market expects those fat earnings to come back down as the cycle normalizes. So the low multiple is the market pricing a peak, not a gift. We're keeping that factual in general, but it's exactly the kind of trap options traders walk into around earnings.
Okay, so what's the market bracing for on the print itself?
3 things, and the order matters. 1. A beat on the headline number is almost expected, priced in. 2. The real swing factor is the guidance, what they say about next quarter. And 3. The sneaky one, even great results can sell off. It's called sell the news. When expectations were sky high, very good can still disappoint.
So being right that the company is doing well doesn't mean the trade wins.
Right. And that gap between being right about the company and being right about the trade is the heart of options. Which brings us to the single biggest idea in the series. Here it is. Forget calls go up, puts go down. Every option strategy is really a bet on 2 things at once. Which direction you think it goes, and how big a move you expect, compared to the move the market has already priced in.
Wait, the market price is in a move? Like there's an official number for how much it's expected to move.
There is, and almost nobody tells beginners about it. It's called the implied move, and learning to read it is the difference between gambling and actually understanding what you're doing.
Before the implied move, when I pay a premium, what am I even paying for?
Two things stacked together. Part 1 is intrinsic value, real, in-the-money value, like a coupon that's already worth something. Part 2 is time value, sometimes called extrinsic value. That's the anything could happen before expiration part. It's pure hope and uncertainty, priced in dollars.
And I'm guessing the time value part is huge right before earnings?
Enormous. Because the uncertainty is enormous. And the moment the news drops and the uncertainty vanishes, so does most of that time value. Keep that image, a big puff of uncertainty value, sitting on top of the price, waiting to deflate. So the implied move. Picture a bell curve centered on today's price, about $1,043. The options market is pricing a move of roughly $140 in either direction by Friday, about 13%. That gives you a band, very roughly 903 to 1183, where the stock has about a 2 in 3 chance of landing.
And how do I find that number myself, without a fancy terminal?
Beautifully simple. Look at the straddle, the cost of buying the call, and the put at the current price together. That combined premium is roughly the implied move. The market is literally quoting you its own expectation. If you picture that bell curve with the shaded band, that band is the whole game's playing field.
Okay, so why does that one number matter so much?
Because it flips every strategy into a simple question. If you buy premium, calls, puts, straddles, you only truly win if the stock moves more than that implied 13%. You're paying for the expected move, so you need an unexpected one. But if you sell premium, you win if the stock moves less than implied, if it's quieter than the crowd feared.
So buyers need a surprise and sellers need a yawn.
That's the cleanest summary of options I can give you. Buyers of premium need a bigger than expected move. Sellers of premium need a smaller than expected one. Everything else is detail. Now the deciding force on the night itself, implied volatility, 4, and its evil twin, for crush. Picture a chart of 4 over time. Going into earnings for inflates higher and higher because nobody knows the result and uncertainty is expensive.
And then the result comes out.
And the uncertainty instantly evaporates. The result is known. So 4 collapses, sometimes from 180% down to 50 in a heartbeat. That collapses 4 crush, and it deflates option premiums across the board, almost regardless of direction. If you can picture that volatility line spiking up and then falling off a cliff the second the news hits, you understand earnings options better than most.
Let me guess, this is where people lose money even when they're right?
This is exactly it, and it's the most important sentence in the episode. You can buy a call, watch the stock go up on good news, and still lose money, because the 4 crush deflated your premium faster than the move inflated it. Right on direction, wrong on the trade.
That is genuinely counterintuitive.
It breaks every beginner's heart once. So the lesson is, around earnings, which side you're on isn't enough. You have to respect the volatility math. Buyers are fighting the crush as a headwind. Sellers have it as a tailwind. Same event, opposite experience.
People throw around the Greeks like it's a secret language. Do I need all of it?
For this series, 3 lightly. Delta, how much your option moves when the stock moves $1. Think of it as your direction exposure. Theta, how much value you bleed each day just from time passing, the clock tax. And vega, how sensitive you are to changes in 4. On earnings night, vega is the star, because 4 is about to move violently.
So if I'm buying premium into earnings, I'm long vega, and the crush hits me.
Look at you. Yes, long vega meets 4 crush, and that's the headwind. Sell premium, you're short vega, and the crush pays you. You've basically got it. 2 more pieces of vocabulary that keep you safe. Defined risk means the most you can lose is known and capped. You could lose it all, but no more than that. Undefined risk means your loss is open-ended, theoretically enormous. Selling a naked option is the classic undefined risk move, and it's where people get truly hurt.
And there's that word assignment I keep hearing.
Right, if you sell an option, the buyer can exercise their right, and you can be assigned, forced to actually buy or deliver the shares. It's a real obligation, not just a number on a screen. So as a rule of thumb for anyone newer, understand defined risk deeply before you ever flirt with the undefined kind.
Can I just open an account and place all of these tomorrow?
No, and that surprises people. Brokers gate options behind approval levels. Generally, a lower level lets you do the safer, defined risk things, like buying calls and puts or covered strategies on stock you own. Higher levels and a margin account unlock spreads and the riskier undefined risk stuff. It's the broker saying, prove you understand the danger first.
Which is honestly a feature, not a bug.
Completely. The gate exists because the undefined risk strategies can do real damage. So as we walk through the toolkit, keep a mental note. Some of these you might be able to place at the entry level, and some you simply can't until you level up by design. Alright, the framework that the rest of the series hangs on. Sort every strategy by that direction times volatility idea into a few buckets. Long volatility plays. You buy premium and need a bigger move than implied. The crush is your enemy. Short volatility plays. You sell premium and win if the move is smaller. The crush is your friend.
And the ones with an actual price target?
That's the targeted bucket. You think you know roughly where it lands, and you build a cheap, defined shape around that spot. Then there are stock owner tools, ways to manage shares you already hold through the event. And finally, the wrong for earnings bucket. A strategy will show you specifically as the counterexample of what not to reach for on a night like this.
So lay out the syllabus for me.
Episode 2, the long volatility, betting the move plays, buying calls, puts, and straddles. Episode 3, selling the fear, the short volatility and targeted plays, where you harvest that 4 crush. Episode 4, managing stock you own, the one tool not to use, and a one-screen cheat sheet that ties it all together. And Episode 5, the reveal. Once Micron's number is out, we put the actual profit and loss on every single structure and see who won.
Same stock, same night, every strategy, real outcome.
That's the promise.
Okay, that was a lot, but I finally get the shape of it. It's not calls and puts. It's direction versus size of move versus what's already priced in, with 4 crush as the referee.
That's the whole game in one sentence. Sit with that framework, because next time it makes every strategy click. And one more time, because it matters. This is education only, not advice. Options can lose you everything you put in, so treat all of it as a way to understand the machine, not a nudge to go feed it.
Come back for Episode 2, where we start buying the move, and stick around for the finale to see which strategy this earnings night actually rewards. Thanks for learning with us. See you there.
Okay, that's our episode. The honest goal here is simple. Hold a few ideas about the world, and keep checking whether they're still true.
Together, out loud, a little at a time. If you spot where we've got it wrong, please tell us. That's how this gets better. See you next time.